Hello, my name is Chris Stegeman. I'm a product specialist here at DoubleLine Capital with a focus on DoubleLine's international fixed income strategies. Today, now that the third quarter is over, I would like to review performance drivers of the DoubleLine Emerging Market Fixed Income Fund, institutional share ticker DBLEX. So with that, let's just dive right in. So looking at this chart here, very straightforward. The fund was down 1.04% in the third quarter. It was tough sledding for fixed income, particularly in August and September as interest rates continued to rise. Over the third quarter, the 10-year U.S. Treasury yield was up 73 basis points, while the 30-year Treasury yield was up 84 basis points. So longer duration assets certainly felt the brunt of that. So you'll see versus our index or our benchmark, which is the JP Morgan MB Global Diversified, was down 2.23%. So for the quarter, while negative, the fund did outperform its benchmark by 119 basis points. And you'll see on the right-hand side there, on a year-to-date basis, also outperforming by 66 basis points. So just peeling that back a little bit in terms of contributors to the relative outperformance, number one was duration positioning. I mentioned how rates went up, particularly in August and September. We are running a shorter duration relative to our benchmark in this portfolio. The benchmark is closer to 7 years, whereas this fund ended the quarter at roughly 5 years of duration. We're also overweight corporates. Our benchmark is a sovereign and quasi-sovereign benchmark. We do have a significant exposure to corporates. Corporates outperformed their sovereign counterparts over the quarter, again, largely attributable to duration, as corporates tend to have a shorter duration than longer dated sovereigns. On the country side of things, our overweight and security selection did help in terms of Brazil exposure and Peru exposure. We are overweight both those countries, and again, security selection contributed as well. From a detractor standpoint, the fund is underweight Europe. We have 0% exposure to Europe versus the benchmark, which is closer to 7%. And Europe year to date and in the third quarter was the best performing region of all emerging market regions. And a lot of that is just coming off of extreme lows experienced last year following the Russia-Ukraine crisis, which is unfortunately still ongoing, but nonetheless, from a financial aspect, emerging market fixed income Europe EM fixed income has rallied off of those lows year to date. We're also overweight Latin America. Latin America was the worst performing region in the third quarter, but I'll get into why we continue to favor that region in just a bit. Taking a quick step back, just looking at emerging market fixed income yields and spreads. We all know the story, but we're at much more attractive yield levels than we were just 2 years ago, albeit it's been a painful ride to get to these, but you'll see on the screen on a going forward basis, or at least as of right now, in the double B and single B rated tranches specifically, you have yields anywhere in the 8.5% to 10.5%, which should certainly help cushion total return if we were to hit a risk-off environment where spreads would widen. And then on the right-hand side is exactly that, spreads. So we're looking at emerging market corporates versus emerging market sovereigns. Sovereigns tend to be a bit wider. The corporate index is a bit higher quality. But nonetheless, you'll see emerging market fixed income. We're currently at spreads on the sovereign index of about 450 with a 5-year running average of 409. And then the corporate index is actually a bit tighter, currently at 337, which is just inside its 5-year average of closer to 350. And then lastly, just into positioning quarter over quarter. So what you'll see on this screen here is straight from the fact sheet with a lot of data, country breakdown, subsector breakdown, et cetera. But just to highlight a few different things, on a quarter over quarter basis, the team did, throughout the quarter, continue to sell out of some of the longer dated sovereigns and some shorter dated corporates that they had deemed to have limited upside on a going forward basis. And they rotated into corporate credits in that 6 to 10 year maturity window that they believe offer attractive spreads And of course, if treasuries were to fall, those credits being in that 6 to 10 year maturity range would benefit from that, and vice versa. They're credits where the team believes that their spreads could compress. So even if rates were to continue to rise, if their spreads were to compress, that should insulate from a total return perspective a bit. So what did that result in? Even if you just look at quarter over quarter fact sheets, first and foremost was duration. Duration came down close to a year from 5.7 to 5.0. High yield exposure, as a lot of these credits that we rotated into were in that double B rated tranche, or not tranche, just double B rated rating. High yield exposure increased from 39% to 45%. And as I mentioned, the double B rated was the area that the team focused on the most. So double B exposure increased from 29 to 34%. Sovereign exposure did come down. I mentioned that we sold some of those longer dated sovereigns, finished the quarter at 13% of the fund. And then lastly, Latin America, which we do continue to favor, is up 3% to 67%. Latin America exporters tend to be hard currency generators and certainly would more or less benefit from a strong commodity cycle. So with that, I will leave you. If you have any additional questions on the DoubleLine Emerging Market Fixed Income Fund or our thoughts on emerging markets, feel free to contact us at fundinfo@doubleline.com, or of course you can contact your DoubleLine sales representative. Thank you and have a great day.